Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at the latest tariff announcements from the US on Friday and over the weekend. We'll also have a look at what's happening with regards to US growth and inflation and what that means for the interest rate outlook. And finally, we'll have a look at vehicle exports out of SA and the latest with regards to South African inflation. We're going to start off with tariffs. As I'm sure everybody is aware, on Friday, the Supreme Court ruled against President Trump's tariff policy. In effect, that meant that the White House needed to go back to the drawing board, and they did so pretty quickly. Later on Friday, President Trump announced a broad-based 10% tariff, and then on Saturday revised that to a 15% tariff. I think it's worth just cutting through the noise and looking at the underlying issue in the US. And the underlying issue is that the US has a debt problem. If you look at total federal interest expense in the US, it's now running at $1.2 trillion on an annualized basis, which is about 16% of their budget, just a bit ahead of defense. And that puts the White House in a difficult position. Interest expense is crowding out other expenditure, and there's only a couple of ways to resolve that. And you can try to get more revenue through hiking taxes, but that's politically unpalatable. You can try to cut expenditure, but that's quite difficult to do. A lot of the expenditure is entitlements. Or you can hope that the US will grow its way out of the problem, or you can try to put pressure on the Fed to cut interest rates. So those are really the options available to the White House. So given the threat to revenue from tariffs, the White House was quite quick to implement a new form of tariff using a different rule. This new rule only allows for tariffs to be in place for 150 days before Congress needs to approve. And that looks like it's unlikely at this point. So where we sit is that we're going to sit with this 15% tariff, which may annoy some trading partners of the US, until such time as the White House can come up with replacement tariffs using a different set of rules, and they will try to get those in place such that the revenue impact is mitigated. Now, these new tariffs will likely be contested as well, along with the tariffs that are likely to come in place after the 150 days, or at some point within the 150 days to replace the current tariffs. So it all is a bit of a mess at the moment. And what's interesting, though, is if you look at the timing of the announcement, you look at the market impact. On Friday, when the Supreme Court ruled against the White House, we didn't see a large market impact. It was largely priced in. What we've seen so far early Monday morning, though, is that the dollar has weakened on the new 15% tariffs, and the US futures market is down between 0.5% and 1%, depending on the index that you're looking at in the US. So the Supreme Court ruling against the White House was largely priced in. The new 15% tariffs, perhaps not, and we are going to see some uncertainty over the coming 5 months as the White House attempts to try to introduce other tariffs to replace the tariffs that have been ruled against, and then those tariffs are then presumably contested in court as well. So there's an element of uncertainty. It is going to make the market environment quite jittery. We are going to have to keep a close eye on this. In the interim, it looks like we're going to have this 15% broad-based tariff over the coming 5 months. By the way, the Supreme Court ruling didn't affect the sector-specific tariffs. So there still would be tariffs on, for example, steel and aluminium. This really applies to the Liberation Day tariffs that are now being reversed and then put back as 15%. In general, Friday was quite tough for the White House. We've just spoken now about how the Supreme Court had ruled against the Trump tariffs. But in addition to that, the GDP print came out on Friday for Q4 in the US, and it was a bit weaker than expected. And the core PCE inflation numbers came out, and they were a bit higher than expected. And we're going to run through both of those numbers shortly and see what it means for interest rate policy in the US. Starting off on GDP, the Q4 GDP number came out at 1.4%. That was quite a bit below the consensus number of 2.8 and the prior reading of over 4. So quite clearly, based on the first reading of the number, a pretty sizable deceleration in economic activity. But a bit of nuance is required. That number would have been affected by the shutdown in the US, and we will likely see a bit of a bounce back in Q1. So we need to take a 2-quarter average. So we'll have to wait a couple of months to be able to get a firm estimate of what underlying growth actually was. One way to do that is to look at a measure of core GDP. And here we strip out inventories, we strip out imports and exports, we strip out government, you're looking at real private sales to domestic consumers. And that number was up 2.4% quarter on quarter annualized, which is pretty good. I mean, in the US, I think, would be quite happy to be growing at sort of 2 to 2.5%. And this number suggests that core underlying activity is still expanding at a rate of about 2.5% or so. However, that does mean that the US economy is likely slowing relative to the rest of the world. We track GDP prints for a wide range of countries, and of those that have reported so far, the median estimate is that GDP growth, the median GDP growth across countries, accelerated to 2.6%, while US growth over the last year has slowed to 2.2%. And we've picked this up now over the past couple of quarters. The US economy is now growing slower than the median economy across the globe. And historically, when we've seen a situation like that, it has been associated with dollar weakness, and the dollar has weakened lately. So the recent weakness is not at all at odds with the economic performance of the US economy relative to the rest of the globe. Again, we do have to wait a bit to see what that final number is going to be for Q1. But even in the event that it's a bit higher than it was at the moment, we are still sitting in a situation where the US economy is slowing and slowing relative to the rest of the globe. Core PCE inflation picked up to 3%. This is the Fed's preferred measure of inflation. Core PCE inflation has got a slightly different weighting to the normal headline inflation series. It's supposed to be more stable. What would be particularly concerning about this print is if you look at inflation over the last 3 months, annualized, based on this measure, and you look at inflation over the past 6 months, annualized based on this measure, they're both running at about 3%. So 12-month core PCE inflation is running at 3%, 6 months is running at 3%, 3 months is running at 3%. There's little to no sign that inflation is coming down in the US. Every measure that we look at over a time period suggests that core PCE inflation is running at about 3%. So where does it put the Fed? Well, we had the Fed minutes from the January meeting come out last week, and in those minutes, they suggested that they see little reason to expect the US labor market to deteriorate further, and in addition, they would require further declines in inflation for interest rate cuts to occur. Now, inflation is not declining, and if they're not worried about the labor market, that means that they're very unlikely to cut. The market at this point is pricing in 2 cuts from the Fed this year, the first to occur by July. If inflation continues to be at this sort of level and GDP growth continues to be at sort of 1 to 2% and the labor market doesn't deteriorate further, it means that they're not going to be in a rush to cut at all. And that takes us right back to the point we made at the beginning, which is that the US government does have a debt problem. And if the Fed isn't coming to the rescue, they really do have to rely on revenue from tariffs. So they are going to attempt a variety of different forms to try to get that tariff revenue to be elevated to try and help with some of the fiscal pressure that the US government finds itself in outside of growth accelerating to 3 or 4%, which we think is very unlikely. And finally, just on the mortgage market, which is, of course, affected by interest rates too, we have seen the 30-year mortgage rate decline in the US. But what's happened is as that mortgage rate has declined from 7% down to 6%, it's become more affordable for people who have had 2 or 3% mortgages to move. Maybe they've had an extra child or they've had to move for work reasons. When the mortgage rate was sitting at 7%, they could have moved, but now that's come down to 6%. It's a stretch, but they can do so. And so what we're seeing is that the effective mortgage rate is actually going up as the mortgage rate is going down because of this phenomenon. And the net result of that is as that mortgage rate comes down, we're actually seeing mortgage interest expense go up for consumers. That's likely to be something, that keeps consumers just on the back foot a little bit in the US. So broadly, given what we've seen in the last week, not a lot of good news coming out of the US at this point, and that does expand, I think, in some way, the market reaction that we've seen. It is interesting that, again, we've seen the dollar weaken this morning based on the tariff announcements, and we've seen the US futures market down. It does suggest that the US market is not acting as a sort of safe haven that it did before. The dollar is not acting like the sort of safe haven currency that it did before either. Finally, switching to South Africa, we've had a couple of interesting data points come out over the past week, and we're going to look at vehicle exports out of SA, we're going to look at inflation, and then we're going to talk a bit about the budget, which is due this week. So starting off on vehicle exports, South African vehicle exports last year to the US were down 75% year on year. The tariffs did what they were intending to do. And as a result of that, SA exports far fewer vehicles to the US than we did before. But there was an increase in vehicle exports to Europe. And that more than offset the decline that we saw in terms of vehicle exports to the US. And in addition, there was a sizable increase in vehicle exports to the rest of Africa. And where we sit at the moment is that total vehicle exports now are largely made up of vehicle exports to Europe. They account for 80% of vehicle exports. And it's an important point. When it comes to the vehicle sector, vehicle exports in SA, our focus should be on European demand. It accounts for 80% of exports. Our secondary focus should be on what's happening in Africa. That now accounts for just short of 10% of exports. The US, by far and away, was much smaller than European exports, and now is even much smaller than it was before as well. So our focus needs to be on Europe. And to the extent that there's an acceleration in European growth, that would be very helpful for the SA economy, SA vehicle exports, and much more helpful than should there be an acceleration in US growth. Onto the inflation number, which came out last week. SA inflation ticked down from 3.6 to 3.5%. We do expect that inflation next month is going to be at 3%, but it's probably too soon to be expecting a rate cut from the SARB. We do expect that inflation post that will tick up again, and I think it's quite likely that the SARB would like, within their forecast, to see inflation settling at about 3% before they'd be comfortable cutting. Over the next 2 years, we're probably going to see quite sizable cuts from the SARB, but we're probably not going to get anything in the near term until they're comfortable that inflation is settling at 3%. Finally, we've got the budget coming out this week. There are a couple of data points worth highlighting. For one, we think that total government revenue will be just a bit above the medium-term budget policy statement forecast, which was about 20 billion rand above the budget last year forecast. So there's an extra 20 billion rand relative to the budget, and that means we don't expect to see the same sort of fight around the VAT increase that we saw last year. We think there's no need to do it because there's extra revenue. The second point to look at is when debt to GDP peaks. Now, in the medium-term budget policy forecast, debt to GDP was due to peak around now. And even if that gets pushed out a little bit by, say, 6 months or so, and it's expected to peak in the next year, we think that would still be a very encouraging development for rating agencies. And should it be the case that Treasury or the Finance Minister presents a trajectory which sees that debt to GDP has either peaked already or was going to peak in the very near term, that would still allow scope for further rating upgrades by the back end of the year. So I would suggest those are the two key things to focus on. It's government revenue and the debt to GDP trajectory, and we will provide an update on both of those and anything else of interest Monday next week. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.